Hey, everybody. It's good to be here today on National Investing Day. My name is Brent Moores, and it's time for a session on strategies for managing market risk. I'm at risk. I'm a senior manager of trading and derivatives coaching here at Schwab, and I'm joined by a friend who I've worked with for a few years now, but not for a little while. Welcome, Nathan Peterson. Nate, how are you doing today?
I'm doing great, Brent. It's great to be back, man. Just like old times, we used to have our today's options market
Yeah.
recap when we exploring various unusual options activities. So
Yeah.
good to see you, man. Doing great.
Yeah, it's good. And I'm glad because this is an important topic that we have today. We'll go into what we're going to be going through in just a minute. But before we get too far into this, I just need to go through a few disclosures here. Equity and index options carry a high level of risk and are not suitable for all investors. The material today is intended for general, informational, and educational purposes only. We'll look at individual stocks today, but they're not individual recommendations or personalized investment advice. The paper money software application is provided for educational purposes only. Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risks, including the potential loss of principal there. And with stop loss orders, there's no guarantee that execution of a stop order will be at or near the stop price. And with a stop limit order, you risk missing the market altogether. So, hey, that's the disclosures. Now let's talk about what we're going to do today here, Nate. We've got a few things. One, uh, I want to talk about market pullbacks because, well, we'll look at the market in a sec, but it's a significant day for us in the market here. I want to talk about preparing for market pullbacks before they happen. I want to talk about some different portfolio risk management tools, option strategies to help you manage drawdowns, and kind of integrated in there, we'll look to place some example trades. But before we get too far into this is the S&P 500, everybody. Notice that little high tag there on that. What, Nathan, talk to us, Nate, about the market here today.
Wow. So Brent, I mean, yeah, what a day to be coming on and talking about, risk management when S&P 500 is at all-time highs. It's rallied what, 14% or I don't even off the lows here. Brent, as you know, a lot of this, in my view, has been driven by that AI infrastructure capex binge that is going on. The rally in chip stocks, the SOX, the Philadelphia Semiconductor Index at a new high today. We do have RSIs on both the S&P 500. That's the relative strength index that measures momentum, which is above 70 on the S&P 500. It hit 85 on the Philadelphia Semiconductor Index last week. I believe it's about 75. But wow, talk about a market that is willing to overlook any geopolitical risks. And Brent, I think the two drivers, it is AI infrastructure, but it's also following a lot of the earnings growth revisions to the
Yeah.
upside that we've seen in the S&P 500. So quite a rally, fresh all-time highs. Brent, I always say it's better to talk about what are those tools to help potentially manage some risk when we're at all-time highs rather than
Yeah.
when we're down 20% and the
Uh,
VIX is a lot higher.
yeah, I'll tell you, Nate. I mean, you look at this chart, all-time highs, you go, oh, ho hum, the world, not much is going on in the world right now. But that's what we're seeing right now. In fact, you know, we asked users to submit questions before this session, and there were well over 200 questions that came in. So we can't address everybody, but there were some that we picked out that were more representative questions, and one of them was, "Hey, I'm worried about a market correction." Well, hey, that makes sense. I think it makes sense to be worried about a market correction or worried about market valuations because we're at an all-time high, because we do see pullbacks in the market. In fact, if we look at this, and I'm just going to pull back, I'm going to pull up, let me pull up a 5-year chart here, because, you know, at the beginning of the year, we had this pullback right here, which was about a 21% pullback. Okay. That's what we kind of call the tariff the tariff tantrum pullback. Back in 2022, we had a 27% pullback. And to take it one step further, if we go back a little bit farther in time, let me go back to, I'm just going to do a quick 10-year chart here for something that is seared in the memory of a lot of people. This was COVID back here. Let me just kind of zoom in. This was COVID. That was a 35% pullback on the S&P 500, even more if you were to look at the NASDAQ. And so this is, as we look at this, just keep in mind, on an average year, okay, going back 50 years, the average pullback, average maximum drawdown there in the year is about 15%, okay? And if you go to like a 5-year rolling period, the maximum drawdown exceeded 30% in 21, almost half of those 50-year, 5-year rolling periods there. So Nate, that kind of illustrates just the magnitude of what we can expect in terms of markets and pullbacks. And, it kind of brings up the question of what happens in a pullback, because one thing I see is sometimes people just start selling out of their portfolio. Nate, what do you think?
Yeah, and absolutely. It seems like over the past decade, or maybe post GFC, there's been, or maybe I should say since, it's really the last 5 years, but the volatility, the hypersensitivity to some of these geopolitical events, global issues that are going on, Fed intervention, expansion of balance sheets. It's just created a much more of these kind of larger drawdowns than, Brent, I remember going back, of course, we had the dot-com bear market, which was very significant all the way into 2002. But then if you go into the years of 03, 4, 5, 6, 7, I remember the VIX was under 10. You would have these very quiet, just gradual rises, grinding higher in the S&P 500. And it just seems, yeah, this is the VIX that Brent has up here, just kind of illustrating when you see those spikes. This is they call it the fear index. You could also call it the uncertainty index. These huge spikes, 85 on the COVID there, on that high there is it is massive. Normally the VIX is around 14, 15-ish in just a normal trading environment. But yeah, Brent, I like how you're kind of pointing out, even 2018, remember we had the Fed, what is it, the tantrum that happened in December of 2018. I think the S&P might have dropped 10%-ish or so within a month. And then the Fed kind of reverted back to their easing stance, which helped the market recovery. But this just helps illustrate the frequency on and the magnitude of some of these drawdowns that we've seen. So they should be expected. And then, Brent, I think to your point that you're kind of conveying is that we're at all-time highs. So we've continued to march higher, even in the face of some of these swift, violent, sell-offs. And so it's really this conversation that we're talking about here is, what are the tools that are available when we encounter some of these situations? Because historically they've happened, so they should be expected.
Yeah, absolutely. And just for everybody's sake here, if you're unfamiliar with the VIX, so this kind of tells you when the market's panicking. If I were to like overlay this, and I'm not going to do it right now, but if you were to compare this to a chart of, say, the major markets, say the S&P 500, it would kind of be almost inverse in a sense that when you see a spike in the VIX, you'd probably see a pretty big drop in the market. So you need to be prepared for the market pullbacks. They happen. And one of the things you don't want to do is you just don't want to panic sell when after the market has dropped down. You want to go in with a plan you've thought about ahead of time as you're doing this, and kind of make it more automatic and try and reduce the motion, because emotions are the things can be very detrimental to your trading success. Is if you're governed by emotion, and this is probably true for a lot of things in life, Nate. If you're just governed by the whims of your emotion, it's probably not the most effective thing here. Now, I want to show everybody something real quick. If you go on to the Schwab.com website and go to the Learn tab on there, there's courses. And on those courses, you can go through, and in a lot of these courses, they'll have investing plan. For example, if I go to income investing and scroll down below the course, there's a section down here under resources. It's a little bit tucked away, but it says income investing sample plan. You can pull that up. And this just gives you an idea of creating a plan, sample entry rules, money management rules, sample exit rules, routines. I'm not asking you to copy these plans, but what I am saying is you may kind of use this as a template, if you will, in terms of the formatting of ideas to think about ahead of time in terms of creating a plan so that you can be prepared for a pullback, a market pullback. Now, having said that, let's talk about some of those strategies, Nate, that may be appropriate here to help deal with market pullbacks and put in place while the market's high. And I don't know, it may go higher from here, Nate. I don't know, but and that's the point. Nobody knows. But you got to prepare for the storm before the rain starts, so to speak, I guess. And I've got on here 4 things I want to talk about here today. And we're going to spend a little more time on the option strategies just because they're maybe a little bit less intuitive. But stop orders, portfolio diversification, rebalancing that portfolio, and then we're going to go into some option strategies there. But any thoughts on this, Nate, before we go and start talking about some stop orders here?
Yeah, no, these are, just great high level kind of guidelines. You have some, some benchmarks that you can point to, some guiding lights, so to speak, in terms of, how to navigate markets here. And, we'll start with the stop loss orders, but, that's when you go and you purchase an investment, the way that I like to think about it, whatever stock that you buy, you've done your due diligence, you've done your fundamental research, you've decided to buy this stock. The way that I like to think about it is as you hold this investment, Brent, you mentioned emotions and money. They're very tied together. So a lot of times when you get into an investment, you may not want to sell it because you don't want to be wrong. But the way that I look at it is, number one, you have a thesis for getting into this investment, this stock that you bought. So if that thesis changes, something changes fundamentally, that should be one of those, okay, maybe it's time to get out of this investment because the reason I got in, it just got basically, voided. The other way to manage it, and this is done with price, is that I have a thesis. I believe this stock is good. The technicals come into play, is it an uptrend? But how do I manage that risk? Where do I get out? At what point is it okay to sustain a certain percentage of a loss? And so, Brent, this is where we kind of bring in the stop loss order.
Yeah, absolutely. So I'm just going to use Microsoft as an example. It's not a recommendation. It's just an example. I have a 20-day and a 50-day moving average here if you're interested. Let's say our thesis is Microsoft is going to go up. We wanted to buy Microsoft, but we said, look, if it breaks below its 50-day moving average, I may consider getting out at some point. And so let's say I put a stop loss at $385. Now, what this does not mean is that I'm guaranteed to get out at $385 if the stock drops. If Microsoft has some bad news or something and it drops down to $320, we're probably going to get out a lot closer to $320 than we are $385. But what stop losses do is, number one, they set your mindset in this kind of think ahead type mindset mentality. Number two, it automates the exit. So you're doing it ahead of time. You're doing it when you're not emotional about the drop. You automate an exit, and it's just one possible method on looking at individual stocks in terms of trying to manage risk there on that. Now, you may have other exit rules on this. Maybe your stop is a lot tighter. Maybe you don't use stops, but I think it's just something to consider, Nate.
Yeah, Brent, no, that's really good. And I think you're hitting on an important point because this is where the emotions and the psychology come into play. So you get into investment. If you don't have any kind of, rules, or what is a stop loss about? Capital preservation. But if you get into a stock and it begins to move into a downtrend. That's why Brent was mentioning talking about breaching some of these moving averages, which are there to help identify trend. But Brent, I can remember back in my trading days that I would get into investment. I had a strong conviction about it. It's in a downtrend, and it would be down 10%. I'd look at it and say, well, I still believe it. And then,
Yep.
I believe in it. It goes down 20%, and I say, well, I definitely can't sell it now.
Yes,
A couple months later, yeah. And
exactly.
yeah, then it goes 30%. You're like, now I definitely can't sell it. Maybe I'm going to add to it. But you're going against what price is telling you. And so, you know, you can initially get into what you anticipated to be a trade, but it becomes a long-term investment because you feel like I can't sell now. So the stop loss order is helping you to kind of mechanically manage the risk.
Yeah, and if I could poll everybody right now or see everybody right now, I said if you raise your hands if you've had that mentality before, if you've been in a losing position and you just feel you can't sell because it's gone down too far, I suspect the majority of people would be in that same boat there. Before we move on from stops, let me just mention one thing. On the Thinkorswim desktop software platform, if you want to put a stop loss in while you're placing a trade, you can right click on the chart, you can go to buy custom with stop. Here's my stock. Of course, you got to change the quantity there. You got a stop loss. You're probably not going to have it as a day order. You'll probably make it a good till canceled order. And then you need to adjust that price. And we said the price was going to, I'm going to make this a market order. And I think we said we were going to do that around $385 as a stop. And then you can confirm and send. Make sure you read all the relevant information. Make sure you're not rushing through like I'm kind of rushing through right now and doing it. But and you know what you're getting into. And then if you decide you want to do that trade, you can click on send and then send that trade. Now, let's move on. Let's move on, Nate. Let's go on to the next item, which is a portfolio diversification. You know, one thing that comes to my mind here as we talk about portfolio diversification is, you know, I've been looking at the the S&P 500, which is a little bit more diversified. But if we look at the NASDAQ, which is a very tech-heavy index, and we look at it, say, from, I'm going to go back a little ways here on this. But if you look at, this was the dot-com bubble. Notice back in 2000, we peaked. We didn't break that above that until 2014. So why was this hit so much harder than the S&P 500? Well, it's a large concentration in tech. So concentration matters, which is why we bring up portfolio diversification, Nate.
Yeah, no doubt. And, I think, Britt, you might have seen those headlines about instead of a 60-40 portfolio, as they call it, 60% stocks, 40% fixed income as like, a traditional kind of baseline. I think there was another introduction of a 25% cash, 25% commodities, 25% stocks, 25% fixed income. Just speaking to the nature of this changing world, these changing asset classes, and that sometimes you might need to make some of these adjustments to have that diversification. Because, Brent, as you know this, there were sectors that performed really well during the dot-com bust. It might have been some of the, what we call the defensive recessionary playbook that you might pull out and get some of those high dividend staple type companies that tend to see that money flow, and you can have stocks that are actually moving higher when, tech is going through one of its, severe sell-offs there. But the point is that you have some of this diversification to help offset some of the potential losses that could occur, so you don't have all your eggs in one basket. So, and I think, Brent, right now in this time frame, yes, we have the digitization of the economy. Yes, technology has been phenomenal. Mega cap tech, in terms of their performance over the last decade, there's a tendency to just want to go gravitate and put everything in tech and everything in the AI build out. But I think we're here, Brent, to just kind of touch on and remind investors that, by diversifying, by going, international, or by going into staples, or by going into some dividend earners or some drug makers, I mean, healthcare, there's so many ways that you can diversify so that you're not so concentrated in the event that we get some kind of correction within technology or within the AI trade. So AI is doing great right now. At some point, though, one would imagine there is going to be a capex arc, a saturation of demand, and there will be some kind of correction. Nobody knows when that's going to happen, but by having a diversified portfolio, you're not going to, get severely taken down when and if that correction does occur.
So Nate, what you're saying is if I have a portfolio of Intel and AMD and NVIDIA and Microsoft, that even though there's multiple stocks there, it may not be diversified.
Am I diversified? No, you are not, Brent.
Okay. All right. Let me bring up a question. I thought it was a great question. Again, we had a lot of questions. I can't get to all of them, but let me just mention. Somebody said, with 40% of the S&P 500 in 10 stocks, largely involved in AI, is it truly diversified? No, it's not completely diversified. Absolutely not. And that's one reason why we're saying, in addition to maybe stock exposure, you can look at some other asset classes as well there, Nate. I mean, there's commodities, there's real estate, and there's bonds. There's a lot of different ways you can diversify. One possible means, without getting into individual symbols here, is you can use ETFs to help you in your diversification journey there.
Absolutely. ETF is basically a basket in and of itself. Depending on the ETF, you can go to various countries and get a basket of the top kind of market cap companies from that country. You can get ETFs for particular industries, for industrial metals. I mean, in this environment, Brent, there's so many ways and so many products that are out there that provide those avenues for diversification through these exchange traded funds. And for those that are not familiar, it's just a ticker symbol like you'd see with any other stock. Yet that ticker symbol might represent 30 underlying companies. So when you buy that one ETF, that ticker symbol, you're getting 30 companies. And so therefore, there's some diversification within that particular ETF.
And just, regarding the S&P 500 lack of diversification, there's S&P 500 equal weight ETFs as well you could use. Again, we're not going to get into the details of it,
right,
but just realize
or recommendation. I was just as an example.
Yeah. Let me just mention something here. Also, this is again in the same section I was there before, under Learn, under Courses. If you go to Simple Steps for a Retirement Portfolio, there's no investing plan on here, but under Resources, it has some things, and this goes right along with one of the questions we had. One of the questions was, how should I structure my portfolio, stocks, bonds, cash, for my age and risk tolerance? If you go through this course, it's going to go through and it's going to give you some model type portfolios. Depending on how aggressive you are, it's going to talk about age. And again, these aren't recommendations, but they're just kind of getting you thinking about different ways to diversify among different asset classes there. Okay, so we've got to move on here just for sake of time. But any final thoughts on diversification or asset allocation here, Nate?
It's just one of the core principles of investing. And it doesn't necessarily state you should have 200 stocks in your portfolio. You could have 10 or 15 or 20. But they may be scattered across various industries and sectors throughout the globe, different countries, so that you're, maybe even some gold and silver, there's those ETFs as well. I mean, the point is so that you have various outlays of your capital all across the globe.
Yeah, and one follow-up question that we got to get to, because I said we were going to move on, but that whatever asset allocation you have can change over time through market performance, or just kind of a quick market performance, or just kind of a gradual drift over time of one stock doing better than another. What should we consider, Nate, in terms of when should we reallocate, look to reset our portfolio allocation if we have certain percentages allocated to different asset classes.
Yeah. So the actual percentage does need to be determined by the individual investor. But if you, let's say you have 10 stocks and they're each 10% of your portfolio, let's say you had one of these, AI infrastructure plays, some of them up several 100% over the past couple of years. And now this one AI infrastructure play, for example, represents 25% or 30% of your portfolio. Well, maybe you might want to sell some of that and then put some of the cash in something else so you can bring that allocation percentage either back down to 10% or maybe just not as high, down to 15 perhaps. That, of course, is up to the individual investor.
Yeah, and you don't have to have a totally equal weighted portfolio in
Right.
terms of every sector equally represented, but it is something where you probably don't want to get too out of whack. I know in 2008, I was talking to a guy who had all his money in oil, and it immediately, it crashed within a few months of that. And when I say crash, massive crash.
Yeah.
And, I don't know what happened with that there, but I think about him occasionally. Now, those are some methods of managing portfolio risk that I think a lot of people are familiar with. Let's move on to one that's maybe a little bit newer to some people. Let me make sure I got the right slide there. And that is protective puts. So we're getting into the realm of options here, everybody. And we're talking about buying puts. And a put option is just a contract that gives you the right to sell the stock, whatever stock the underlying is, at a particular price at any time up to the expiration date of that option. So I don't want to get bogged down into definitions here, okay? But let me go through some advantages, disadvantages. Then I want to go to the Thinkorswim platform and show you kind of an example of how it could potentially affect, how your portfolio can be affected by putting in this kind of hedge strategy on. But what protective puts can do is they can provide a measure of downside protection during the life of a put. There's an expiration date on it, and so it doesn't do you any good after that option expires, but during the life of the put, that can provide some downside protection. It allows you to set a floor sales price. It doesn't require the equity position to be sold. You can buy the put, and then you can look to sell the put at some point when you want to get rid of that trade. Now, there's not technically a guaranteed market, but you should be able to sell that, maybe not at the price you like, because the market's always changing, and it may be a favorable price or it may not be a favorable price. And we'll look at some examples there on that. But those are some of the advantages there. But they cost money. That's something. Time, everything else equal, as time passes, it kind of hurts the premium of what the cost is. So if it's not actively helping you, if the stock just kind of goes sideways, you could still lose money on this. And these can expire worthless. So let's do this. Let's go, and I'm just going to pull up a stock. And this, for our sample stock, again, just an example, I'm going to pull up Apple. So here's Apple stock. We just had earnings, nice earnings on Apple. It's up today, and you could say it's had a nice run. And maybe you don't want to sell your Apple stock, but you want to hedge the position, protect it a little bit. One thing you can do is you can go to the trade tab. I'm going to go out 48 days on our example here. And I'm going to look at a put, and I'm just going to go to say, I'll go to a 270 put here, 270 put. And what I want to do is I'm going to look at a tool called the Theo Price tool here on the Thinkorswim platform. Basically what it's saying is you could buy a put right now for about $490. You got to multiply this by 100, $490. Let's say Apple drops by about 10% over the next couple weeks. So I'm going to go out a couple weeks. I'm going to say we drop 10%. I'm going to put minus 10% on here. We're going to look at this now. The 270 put, which we bought for about $4.90 or so, would then be worth about $18 or $18.50 or $1,850 there. These are approximations. It's just an estimation. But the point is, while the stock of Apple goes down, the put price goes up. It may not, in fact, it's not going to completely make up for your loss in this example of what we'd lose on the stock, but it's better than nothing. It's there to help you on that. And depending on what strike you choose, it'll cost something different, but it may offer more or less protection for you on this. This is what we call a hedge. On this case, we're using Apple as an example, but that's kind of how a put works there. Nate, what would you add to that here?
Yeah, no, great. Some say that it is similar to an insurance policy. I pay for an insurance policy on my car. If I get in a wreck or if I total it, then that insurance policy helps to cover that. This protective put, and Brent said, you get one put contract, you multiply that by 100, that will cover 100 shares of Apple for every one put contract. There is a price, $495, as Brent is indicating. If Apple stays above 270 up until June 18th, you lose the whole $495. If Apple drops to $0 per share next week, you get to sell your Apple 100 shares at $270. That's the insurance, the benefit. And then, as Brent talked about, what's important is the time decay. So every day you should anticipate, since you're long this put option, you would buy to open this put option. There is time decay because time is money in options. It's a contract, has an expiration date. The longer out in time you go, the more expensive it generally is going to be. Every day you should anticipate, a little bit of value will begin to erode, all things else being equal, from this put contract. And like an insurance policy, though, you generally are not going to continually buy put contracts. You might do it under a certain period of time where you feel uncertainty's high or you're worried about a drawdown. Brent, right now we've got this Iraq conflict going on. We've got there's seasonality. June seasonality is generally not good for the stock market, as well as February and September. So if you say it's been a great run for Apple, I would like to be able to have this option of being able to sell it at 270, regardless of what happens to the stock between now and June 18th. You ask yourself, $490 or roughly 1.7% of the principal, is it worth it? That's the question you ask, and you determine, do I want to purchase this, limited protection up until June 18th?
Yeah, just a couple points here. You may go, $500 is a lot of money. Well, it may be a lot of money, but keep in mind, we're talking about 100 shares of stock. That's $28,000 worth of Apple stock we're talking about here right now, trying to protect. I illustrated right here what would happen if the stock price does nothing and it just goes flatline between now and I did 2 weeks from now. Notice this is illustrating some of that time decay there on that. We're losing some value on that put option just from the time decay. Now, the scenario I originally gave you was Apple going down 10%, which isn't, that's a big move, but it's certainly not unreasonable on a stock that can move like Apple. Also, of course, if Apple goes up, let's say Apple goes up 10%, which is about $30 on this, so about to $310. Well, this is going to go way, way down in value to practically nothing, probably. And of course, at expiration, it would be worth nothing there. So that's an example of what we call a protective put. You're buying a put on a stock that you own. Now, technically, and that's beyond the scope of this webcast, but technically, you don't have to even own the stock to buy a put. But in that case, it's not a protective put. What we're talking about is a protective put trying to protect different stocks. Now, Not every stock out there has options. The vast majority of the bigger stocks, the household name type stocks, do have options, but it is possible that you may come up with a stock that does not have options there. And we have a lot of education, further education on options that you can use there. Let's see. Anything else to add here, Nate, on protective puts?
I think you've covered it really well. It is market timing. You would be saying, I believe between now and June 18th, there's a higher probability that the market and or Apple is going to pull back. I'm concerned, and therefore I'm looking to seek out, some protection, some hedging. This is one way to do that. But Brent, when you're asking these questions to yourself, do I want to pay $500 for protect? Like I want protection, but $500 is too much. Do you have any other alternatives?
Well, you can, number one thing you can certainly do is you can use a different strike price here on
Yes.
this, and you can go out farther out of the money. And so what that works is if you look at this, I have 20 strikes shown here. You can add more if you need to, but you don't have to. But what you can do is you can see the different strikes, the different costs, the premiums for these different contracts. And you can go, oh, well, let's go to, $250 strike price. That's $168. Maybe that sounds a lot more reasonable. There's pros and cons.
Yeah.
This is farther out of the money, so what that means is that Apple would have to drop further in price in order to get the full value out of this for it to be in the money. But keep in mind, you don't have to hold it necessarily all the way to expiration. If Apple starts to drop, and let's say it drops significantly quickly, but you anticipate then a rebound, you can then look to buy back the put at presumably a increased value, which helps out your portfolio, and then you can remove that protection there. But so, you can use different strike prices there. You can go, if you want a lot of protection, you can go closer to being right where the current stock price is. It's going to cost you more, but it'll give you more protection there. So it's something you just need to ask yourself on that. Okay, so that's protective puts. Now, one other thing that we don't really have time to get into today, this is protection on an individual stock in a portfolio. So in this kind of sample portfolio here, I've got 100 shares of Apple I could do that on. But if I want to protect the entirety of a portfolio, there's other ways to do it. You can go to the realm of index options. There's pros and cons of index options, but if I do a long put on an index such as this may do a better job of trying to protect an entire portfolio. But just be aware, these can be pretty expensive there, Nate, can't they?
They absolutely can. The VIX, like the chart of VIX that you were showing, is going to tell you on a relative basis how expensive options are. So you can see where we are around 17 right now. We were up at 35 at one point, so double the cost, we'll say it just generally speaking. But this is your measure of inexpensiveness or expensiveness of options. It measures the demand for protection on the S&P 500. And to Brent's point, if you have a portfolio that is, let's just say it moves closely with the S&P 500, you could then say, well, I'm just going to go buy some S&P puts on the SPX. You can determine how many you want to buy to get what level of protection you want. And if the S&P goes down, the puts go up in value, you can use the gain from those puts to help offset, theoretically, the losses that your portfolio would incur.
Yeah, one other thing here, and if you want one alternative symbol, again, not a recommendation, is if you determine these are kind of too much for your portfolio, there's a smaller 1/10 the size contract called the XSP, which is going to move more or less in the same direction, lockstep with the SPX, just 1/10 the amount there on that. And the prices on the options are going to be about the 1/10 the level there. So Nate, I think that's protective puts. We talked
Uh-huh.
about that. Maybe we don't have much time, but maybe we could do a quick talk about callers here real quickly, and discuss what the variation is with when we start talking about callers.
Yeah, that absolutely. So, callers primarily for those individuals. I want protection, but I don't want to pay for it, or I just want to pay very little for protection. Do you have anything that can kind of address this? Well, yes, but there's trade-offs. There's always trade-offs with every option strategy. So what is the caller? You're basically having that protective put, but you are simultaneously selling an out of the money call and using that premium to help either fully or mostly purchase the put. So as you can see, the caller on this screen, the on the left side, the red rectangle there, that's where your loss is limited. That's because you have the protective put. And let's say that you got it at no cost. We'll just say theoretically in this example. That means I bought a protective put for $2, but I also sold an out of the money call for $2. So net net, it was zero, excluding commissions. So you have your protection in place at the strike price of the put, but look at the upside of the other side of the chart, the top of that green rectangle. That means that since you sold a call, you have an obligation to let go of your stock at the strike price of the call in the event if the stock rallies above the strike price of the call. So, Brent, this is an alternative. If you say protective put is too much, maybe I can collar my position. It's kind of a holding pattern, so to speak. Now, because you're selling a call on a stock that you own, you are obligated to let go of those shares if you get assigned, meaning that the stock closes above the strike price at expiration, or you even just get an assignment request, meaning your shares have been called away. That can occur. So you would have to be okay, just similar with a covered call strategy, you have to be okay with the event that the stock gets called away from you, meaning it gets taken out of your account. It'll be sold at the strike price of the call. But Brent, this is an alternative to a protective put. You're going to get that same level of protection, but instead of paying the money, you say, I want to sell a call. Generally speaking, most would select an equidistant strike price. You could select whatever ones you want, whatever expiration you want. So, for example, Apple's at 280. You might buy a 270 put and sell a 290 call. Equidistance from the current price. Theoretically or ideally, it would be around zero or a very low cost amount. And then you would basically have that protection. And then if Apple rallies above 290, you can either buy back the call if possible, or you would get assigned and they would take the call. They meaning it's kind of a fungible contract. There's no other person that you sold it
Yep.
to, but they could take that there.
Yep. And so just to make very concrete and practical here, we're going with the assumption that you own Apple, 100 shares here. I'm going to go to the put side of the equation. We're talking about buying the put for just shy of $300. That's the protective put part of it. We're talking about selling a call, and the price is moving on us a little bit for just a little bit over $300. So that would actually generate a little bit of a credit here in this case. And so if we wanted to, what we could do is we could go and we could look. And by the way, anytime you want to buy something, you can just click on the ask price. Okay, there's the put. And if you want to sell something, you can. Well, we're doing 295. Let's see, 290. If you wanted to sell the call, I can hold down this control key just so it has both of those in there. And often, as Nate said, will be roughly break even in terms of credit. But in this case, it gives us a little bit of a credit on this, about a $50 credit. And then you can confirm and send. Remember, I already have the Apple stock in this case. That is a caller there that we just put on there. That's an example caller trade. Now, folks, sadly, we are Oh, time flies.
It does.
Time flies.
Yeah.
So that's about all we have time for. Let me just mention a few things before we wrap it up. Number one, if you like the content today, we appreciate the thumbs up, the like, clicking the like at the bottom of the screen. It helps us out in our pursuit of free education. Same thing with the subscribe. If you like content like this in the future and Schwab Trader Talks Education, click on the subscribe button. If you haven't subscribed already, it should be right on your YouTube screen there. You should be able to subscribe to Schwab Trader Talks there. And then finally, there's a survey. So we appreciate you filling out the survey, giving us some feedback on the session. We're just glad you let's just and so just fill things out, and everybody just remember that thinking ahead of time is the time to prepare for market pullbacks. Any final thoughts from you today, Nate?
Yeah, that's it. Respect that there's ebb and flows within the markets. Have some kind of plan. There's so many resources at Schwab, whether you want to read it, watch it, or participate in a live conversation with one of our coaches. We've got you covered. So just know what's available to you, especially in these types of market environments.
Awesome. Well, thanks for joining me, Nate. Thank you, everybody, for joining me today. We appreciate you. And we got another session coming up at the top of the hour. Bye-bye, everybody.